Hello everyone, this is Ted Bauman here with your Friday Bauman Daily video. As promised, here is the second in my guitar collection. This week is a 2008 Fender Telecaster Deluxe, which I bought because every once in a while I want to twang. Anyway, that's enough for the guitars for today. Today I want to talk about some of the challenges, some of the questions that you folks have put forward to me, particularly about the question of whether I'm shorting the market, whether I'm negative on the market. No, I'm not. In fact, I'm very positive on the market, and my Bauman letter, which you can subscribe to up here, and the Alpha Stock Alert, which you can also find up there, have done very well this year. I'm going to show you precisely why I feel it's so important to have an investing strategy and why I'm not shorting. I'm actually making money in the markets with my services, not just making it up. And I want to show you what the deal is. First of all, I'm not pessimistic about the stock market. In particular, I'm pessimistic about it in general, and you know why. Because I believe that it's in bubble territory. I believe that a lot of things have contributed to an overall rise in stock prices that people have come to misinterpret, I believe, as a long-term trend as opposed to a short-term thing. Now, why is that the case? Well, there are a number of reasons. And the first one, I think, is that there's been a lot of money in the market. I covered this topic a few weeks ago where I talked about the emergence of Robinhood and all that sort of thing. But today I want to show you a couple of charts that really demonstrate why I think this is such an important factor. The first chart shows the way that the stimulus money that came from government earlier this year was used by households at different levels of income. And as you can see, with the curious omission of the $75,000 to $100,000 income level, a lot of people put money into securities trading. Now, clearly that is an indication that they felt that there was not only an opportunity to make money out of it, but that they had extra money to be able to do it. This next chart shows where that money came from. You can see that U.S. personal income rose dramatically at the beginning of the year thanks to the stimulus and also thanks to unemployment payments. But spending dropped significantly since people were not going out and patronizing restaurants and bars and spending money on clothing and things like that. Correspondingly, the savings rate went up, and when the savings rate goes up, that means that at least some people have the opportunity to spend more money on stocks, which is clearly what some people did. We can see in this next chart that the rise in the monetary base, which is essentially the increase in the money supply occasioned by the federal stimulus packages, tracked pretty closely to the rise in stock prices represented by the Wilshire index. So this is from the depth of the drawdown in the stock market during March to the more recently, we're up almost 35% if you take all US listed stocks. Now, next chart I want to show you is the evidence that really a lot of this was coming from traders who really were kind of new to the market and also who probably had that extra stimulus cash in their pockets. A lot of young men, I know some of you are out there, who, probably between the ages of about 35 and 45, maybe younger, 25 to 45, stimulus money in your pocket, and a lot of people went under Robinhood. You can see that particularly options trading just absolutely exploded on Robinhood, which is a pretty strong evidence in my book that Robinhood has played a big part of the current stock price upswing. Now, that doesn't mean that a lot of stock prices haven't gone up because they deserve to. A lot of stocks have gone up because they deserve to. And I'm going to come to that in a minute. But first I want to show you a list of the top stocks on Robinhood and how they have performed this year. As you can see, at the very top of the list in terms of return have been, some pretty understandable positions. Tesla, Plug Power, which is basically a hydrogen energy company, Amazon, Snap, Microsoft, Apple, GoPro. Many of those, with some exceptions, are stocks that I'm also in favor of. But then look at the bottom of the list. Now, overall, the top held stocks in Robinhood accounts this year, and this is from the website RobinTrack, most of them are actually in negative territory. So the win rate is a little bit over a third. Now let's compare that to my two newsletters, and I'm going to show you the time-weighted return, which is basically the return that you get if you basically look at how long you've held a stock, each individual stock over time. For my Alpha Stock Alert portfolio, the time-weighted return for this year is 18.63% versus a comparable return from the S&P 500, which means taking the same amount of money on the same dates and investing them in the S&P index, SPY, you get a return of 3.22%. My alpha on that service is 15.41%. In the Bauman letter, the time-rated return is 31.61% versus 5.33% for the S&P 500 for an alpha of 26.28%. So that compares to an alpha for the average basket of Robinhood trades, the most popular trades, of 3.11. So overall, that you ask for evidence, there's the evidence. Obviously, I cannot list the specific stocks that are in my services because it's a newsletter service. That's what I do for a living. But fundamentally, I have made money. We've made good money. We have not shorted the markets. What we've done is we've picked stocks that are reliably going up. We've been choosy. In other words, we have looked at the stock market as a whole. We have taken the stocks that we believe have the best likelihood of providing positive returns and therefore returns over the market index, which by definition is alpha, and we have achieved that. By contrast, the most popular stocks traded on Robinhood have not done that. So with the exception of specific individual stocks where people have made a great deal of money, only possibly to lose that if there's a downturn again, which has been happening with airline stocks, for example, in the last couple of days, then I think we've done very well. And so I stand by my service and also by the analysis that underlies it. Now, here's why being choosy matters, and here's why a service like mine, I'm not just doing it because I'm trying to sell it to you, I'm just trying to tell you what it is people like me do and why I think it's a good way to look at the stock market. Now, let me show you why I think it's important to be choosy, like we are at the Bauman letter, why it's important to try to target the companies that are going to go up and stay up. Now, if you look at the S&P 500 for a moment, which is useful because it represents mainly the brick and mortar side of the economy, as opposed to the NASDAQ, which is mainly tech, only 153, or a little over 30% of those companies are actually up for the year. The other 70% are down for the year. And of the ones that are up, the average gain is about 18%, but most of the companies, about 2/3 of them, fall below that 18%. There's 50 companies that have a much higher level of gains, and those are the kind of companies that we look for here at the Bauman letter. Now, the idea is that even when the stock market is going up all over the place as a whole, you still want to look for the companies that have the prospects, and that's exactly what we try to do. Now, let me explain why that's so important. Let's look at a chart that shows the number of sectors compared to the S&P 500 and the NASDAQ. Now, as you can see, the S&P 500, which is the purple line, fell but has risen again since the beginning of the year, whereas the NASDAQ fell but has actually exceeded its earlier performance in the year. But if you look at things like energy, banking, consumer discretionary, industrials, and airlines, for example, all of them are lagging both the S&P 500 and the NASDAQ. Now, the importance of that is that I believe that the real gains in the stock market are coming from a small handful of companies at the top of both the S&P 500 and the NASDAQ, whereas the majority, as the facts show, are actually not seeing real gains. Now, some people have made good money by buying some of those companies at the dip, which is hard to spot because you never know whether it is the dip or just one dip amongst many. Won't go there today. But basically, some people have made money by buying them and riding them back up again. Now, that can work as long as you know when to get out. And unfortunately, as we've seen, a lot of the popular stocks in the Robinhood type portfolios, like the cruise lines and the airlines and things like that, have actually started to reverse course because of the dramatic uptick in the number of COVID-19 cases. Now, I think it's true that tech stocks are more resilient in the pandemic, and I believe that many cases they are justified in seeing the increases that they have. And for anybody who, like us at the Bauman letter and the Alpha Stock Alert, have focused on companies that have true underlying value as opposed to speculative value, you'll do well. But I think we're headed for a period when the tables are in a sense going to turn, and they are going to level off and perhaps begin to see some declines, and here's why. First of all, let's look at the number of companies that have provided actual earnings guidance for this year. As you can see, the number has declined dramatically And essentially what that means is that companies are simply not willing to put on paper what they think their earnings are going to be in the next couple of quarters. The next chart, on the other hand, shows what Wall Street analysts think. They think it's going to drop basically for the second quarter when we see earnings is going to drop from an average around $37 per share in the S&P 500 to $23. That's a big drop. At the same time, we've seen the average share price or the level of the S&P 500 rise to over 3,100. So clearly people are pushing up stocks in the face of declining earnings estimate. But effectively what they're saying and what they've been saying for some time is that they are looking forward to improvement in earnings coming forward. Here's why I think that is so important and why it can change the situation for a lot of us. When companies are not releasing earnings, when all we have is guesstimates, really, even analysts don't know what to say because of the unprecedented situation, then it's basically you're buying on faith. You're saying, well, I'm going to buy this company because it's going to bounce back someday and its stock price is going to recover. Now, when most companies are in that situation, then it makes sense maybe to buy a broad range of companies because all of them are going to go up because everybody has faith that things are going to get better. Problem is that as time passes, as we head into earnings season starting next week, we're going to start seeing some actual numbers. We're going to start seeing what companies are actually earning or not earning. And as that happens, basically, we can no longer just rely on faith. Because as those numbers come in, you're going to start to see a divergence. The companies that are not performing, that are really suffering and have now put a number to it, are going to see some declines in their share prices. People are going to say, well, maybe it's not such a good idea to just have faith in a company that just saw a double-digit decline in earnings quarter to quarter, maybe even from year to year. Now, in that kind of a scenario, it then becomes important to understand the fundamentals behind those companies. And that, again, will shake the faith, I think, of a lot of investors who've just thought, well, I can just throw a dart at a list of companies and I'll still make some money. Well, that's not what's going to happen. I think people are going to find that as the real earnings come in, as we begin to get real data about what's happening in companies, you're going to have to be choosy. You're going to have to say, well, I'm going to choose this company over that company because of the actual numbers, as opposed to just faith that they're going to get better. Now, the third thing is that a lot of the cash that people have had to engage in that kind of speculative buying is going to run out. Now, that doesn't mean to stay away from the stock market. It doesn't mean to short the stock market. If you think that that's my main message, you're mischaracterizing what I'm saying. What I'm saying is you just need to be choosy. And that's what I've been saying all along. You need to look at companies the way we do, which is basically in 3 steps. First, where in the economy are companies likely to be resilient and likely to grow? For example, in technology, we know that those companies are relatively resilient. That's why a lot of my investments are in things like online commerce, cloud computing, etc., because I know that those companies are not going to suffer as much as others. Then the second question is, which companies in particular should we be looking at? And that's where fundamental analysis comes in. Which companies have the best track record, which are likely to recover quickly than others, which have the best cash positions, the best balance sheets, all that sort of stuff. Again, that's not something that you can do just by, speculative, sentiment-based trading. You actually have to have some information, and as that information comes out, the advantage will shift to those of us who look at that information. The third question is when to buy them, and then, of course, that involves things like companies that are on the verge of breakouts, stocks that are on the verge of breakouts, stocks that are in consolidation, stocks that are on the verge of a pullback, all that sort of stuff. So knowing when specifically to buy the company as opposed to just buying companies when they're down, that becomes important. So applying that, what am I looking at going forward for this year? How am I going to improve upon the already good performance that we've seen in our portfolios at the Bauman Letter? Well, here are 3 sectors that I think are going to do well. The first one is automation, broadly robotics, sensors in particular, which are critical to robotics and automation, and process control. All of those things are going to be in hot demand because I believe that we're going to see an uptick in the amount of automation right across the economy because vulnerability to COVID-19 only applies to human beings, not to machines. And like it or not, I think that's going to have a dramatic impact on the way companies operate. And even though our trade relations with China are changing and supply chains are changing, I think the pandemic and the threat of future pandemics is going to lead companies to invest a lot of money in that. Ergo, that's one of the sectors that I am looking at closely, and I would recommend you do too. Second one, renewable energy. I believe that right now, with the cost of renewable energy being below that of things like coal and oil and even natural gas in some cases, it's a good time to be looking at buying into renewable energy. Investments are going to come. We're going to see serious money made in that sector. You can include things like electric vehicles. I'm very bullish on a couple of electric vehicle companies. I think Tesla's overpriced, but I believe that there are a couple of other companies that are going to catch up to it rapidly. The third one, and this is one that may surprise you, is heavy equipment and civil engineering. I believe what's going to happen next year is that whoever's in office, whoever controls Congress and the White House, doesn't matter, they're going to say, well, we need to continue pumping money into the economy, but we can't just keep doing it through handouts. Why don't we recharacterize it as investment and start doing something about the terrible state of our infrastructure here in this country, where almost 40% of national bridges are in serious need of repair. We don't have high-speed rail. Every fifth mile of our national highway network needs to be repaved. All these kind of things need to be done. So my bet is that whoever's in power, doesn't matter, Republicans, Democrats, they're all going to look at it the same way. They're going to say, we need to keep pumping money into the economy, but instead of doing it through handouts, let's do it through a massive public infrastructure program, which it's much easier to sell politically and so on. And so my third bet is on those kinds of companies that involve and benefit from those sorts of things. So there you have it. Basically, no, I'm not shorting the market. No, I'm not a perma bear. Those of you who think so, those of you who think that, I only think things are going to go down. No, but the facts are the facts. Most companies have lost money this year. A much smaller proportion have gained. Looking to focus on those companies is the way that you make money in the long term. And we're getting into a situation where you can no longer rely on faith and sentiment just to make money, because not all companies are going to keep going up once we start seeing real earnings. Anyway, that's my message for you today. Next week I'll be back with another guitar and another message, and I'll try to make it a positive one. Thanks and take care.